Welcome to the Pro Ticker Deep Dive. We are looking at a fundamental, just a massive reshuffling of the healthcare industry right now.
Hmm.
I mean, if you're in the C-suite at a Johnson & Johnson or a Pfizer, the big question is, well, it seems simple. Do we buy the innovation we need, or do we try to build it ourselves?
And that one question, buy or build, is driving this absolutely unprecedented consolidation boom.
So this isn't just normal M&A chatter.
No, not at all. This is way more aggressive. We're tracking announced pharma deals worth over $138 billion, and that's just through the third quarter of 2025.
Wow.
Yeah, to put that in context, that's nearly double the pace of prior years. It's a strategic realignment. So our mission today is to really break down what's driving this, what the big strategic plays are, and, what it all means for how you should be thinking about the entire healthcare space.
Okay, let's get into it. The scale is huge, but why now? What's the sudden urgency that's pushing these normally cautious giants off the sidelines?
It's really two massive forces hitting them at the exact same time. They're sort of running toward a huge opportunity, but they're also running away from a massive deadline.
Okay, let's talk about the deadline first, the scary part. What's the necessity here?
That would be the patent cliff. And it's a real crisis. We're talking about blockbuster drugs, things like Humira or Stelara that are losing their patent protection.
The ones you see ads for constantly.
Exactly. And the moment that happens, you get this avalanche of generic and biosimilar competition, and those huge profit margins that fund all their future research, they can get wiped out. We're talking an erosion of 50 to 80%.
So billions of dollars in revenue just vanishes.
Tens of billions. So you can't just wait for your internal labs to come up with something new. You have to go out and buy a solution.
Okay, that makes sense.
Yeah.
So if internal R&D is too slow, why can't these huge companies, the Pfizers, the Mercks, with the biggest budgets, just, innovate their way out of the problem?
And that's the second force. Innovation acceleration. The science being developed right now is just incredibly complex. I mean, you've got next-gen GLP-1s, you've got CAR T-cell therapies, AI-driven drug discovery.
All the cutting-edge stuff.
Right. And developing that in-house can take a decade with a ton of risk. So what these companies are realizing is that an acquisition can compress that timeline from years down to just a few quarters. They can buy science that's already proven, maybe even already has FDA approval. It's just faster and a lot less risky than starting from scratch.
And it seems like there's a bit of a tailwind helping these deals along. I mean, historically, antitrust regulators would have been a huge hurdle, right?
That's a really critical detail, yeah. The whole enforcement environment has shifted. Instead of just blocking a deal outright, regulators are more open to what they call remedial solutions.
What does that mean in practice?
It means they might say, okay, the deal can go through, but you have to sell off this other division to maintain competition.
Ah, so it avoids a total dead end.
Exactly. It dramatically reduces the risk of a deal getting stuck in court for years, so executives are a lot more confident pulling the trigger.
So you've got less regulatory risk. And I'd imagine the financials are looking pretty good, too. What about valuations?
That's the fuel for the fire. Biotech valuations have been pretty compressed lately. It's a genuine buyer's market. You have these promising smaller companies, the ones with the exact pipelines big pharma needs, trading for less than the cash they have on hand in some cases.
Seriously?
Oh, yeah. So if you're a big pharma company with a strong balance sheet, it's a golden opportunity to grab these assets at a serious discount.
So this isn't just random spending. It breaks down into some very clear themes. And it seems like we have to start with the hottest one. The GLP-1 gold rush, the whole metabolic disease land grab.
It is a tectonic shift. It really is. I mean, GLP-1 drugs like Wegovy and Zepbound, they've shown they can do so much more than just treat diabetes. They are effective for obesity, which affects something like 40% of adults in the U.S.
The market potential must be staggering.
It is. Projections are hitting $100 billion annually by 2030. So every single major player feels like they have to be in this space, and they have to be in it now.
So what does that urgency look like in, actual dollars and cents?
You're seeing incredibly aggressive moves. Take Novo Nordisk. They're already the leader, but they just put up over $5 billion for Akero Therapeutics.
Why? If they're already leading.
Because they want the next generation of obesity drugs. They can't stand still. And then you have Pfizer, who is late to the game, making a $10 billion payment for Metsera just to get a weekly GLP-1 candidate.
$10 billion. That's just the price of admission.
That's exactly what it is. It shows how desperate they are to get a seat at the table.
And when they buy these drugs, are they just thinking about obesity? Or is the bet much bigger?
It's a much, much bigger bet. That's the key insight here. When you acquire a GLP-1 asset, you're not just buying a drug, you're buying a platform. The science shows these therapies can impact heart health, kidney disease, all sorts of things.
So it's a multi-tool.
Precisely. And that urgency is spilling over into related areas like steatotic liver disease or MASH. We saw 3 pharma giants deploy over $8 billion in just 150 days, chasing a specific type of drug for that.
$8 billion in 5 months.
Yeah. Roche spent $3.5 billion on GSK spent $2 billion. The competition is just incredibly intense.
Okay, let's switch gears to oncology. Cancer drugs have always driven M&A, but the pattern seems to be a bit different now. It feels less about moonshot research and more about precision.
That is spot on. Oncology M&A today is very focused. It's about de-risked niche therapies that have a clear path to market. They're looking for drugs that are either already FDA approved or very late stage, not early, speculative research bets.
Can you give an example of that preference for immediate revenue?
A perfect one is J&J's strategy. They spent over $14 billion on intracellular therapies. And what did they get? They got Caplyta, which is an already approved revenue-generating psychiatric blockbuster, plus the rest of their pipeline. So they bought an instant revenue stream.
They bought sales, not just science.
That's a great way to put it. Same with Sanofi. They spent $9.5 billion on blueprint medicines to get Ivakit, which is the only approved therapy for a rare blood cancer. These are very targeted, high-margin plays.
And technologically, there are some hot areas, right? I keep hearing the term antibody-drug conjugates.
Yes, ADCs. They are a huge focus. Think of them as guided missiles for cancer. They take a really potent drug payload and attach it to an antibody that specifically targets cancer cells.
So it's all about precision delivery, hitting the cancer and leaving healthy cells alone.
Exactly. Better efficacy, fewer side effects. AbbVie's $10 billion deal for Immunogen was all about getting their ADC platform. Acquiring these companies gives them the specialized manufacturing and the expertise it's impossible to build from scratch fast enough.
Okay, let's move over to medical devices. MedTech consolidation seems to be playing by a totally different rulebook. What's driving companies like J&J and Stryker on the device side?
It is a different logic. MedTech M&A is driven more by cost pressure and the need for scale. Hospitals are trying to cut costs, so they want to buy from fewer suppliers. To compete, device makers need to offer a comprehensive portfolio. Their strategy is usually lower risk. They call them bolt-ons.
Bolt-on, so just filling gaps in their product line.
Exactly. Look at J&J's $13 billion acquisition of Shockwave Medical. Shockwave has this unique technology that uses sonic waves to break up calcium in arteries. J&J didn't have that. It was a hole in their cardiology portfolio.
So they bought it.
They bought it. It's a proven technology with existing revenue. It slots right in. It's very different from pharma's big bets on future drug pipelines.
And we're seeing that bolt-on strategy elsewhere.
Oh, absolutely. Stryker bought Inari Medical for almost $5 billion for their clot removal tech. Boston Scientific bought Axonics for nearly $4 billion for a proven revenue stream in neuromodulation. It's all about complementary tech and reliable cash flow.
With all this strategic buying, where's the private equity money?
Right.
They're usually all over this kind of action.
They've largely pulled back, actually, at least on the mega deals. With higher interest rates, the cost of borrowing is way up, and exit multiples have come down. So that classic PE playbook of buy, roll up, and sell is just not as profitable right now.
So the big companies are driving the bus now.
They are. The strategic buyers account for something like 60% of the deal volume. They're motivated by necessity, not just financial engineering.
So let's talk about the risks. These companies are paying huge premiums, 20 or 30% over the stock price. Isn't that just trading the risk of R&D failure for the risk of a messy integration?
That is the absolute core of the paradox they're facing. Yes, the upside is huge. You de-risk your pipeline, you skip years of development, you can capture significant cost synergies. But the reality is that integration is incredibly complex, and history is littered with failures where the promised value was just destroyed because two companies couldn't work together.
And what about the people? The culture clash between a huge pharma company and a small, nimble biotech seems like a recipe for disaster. You risk losing the very scientists who created the value.
It's a critical risk. The talent flight is real. These scientists thrive in an autonomous, mission-driven environment. If you swallow them up into a big bureaucracy, the key people can just walk out the door.
So the asset you bought is suddenly worth a lot less.
A lot less. So you see smart acquirers use things like big equity rollovers or long-term earnouts to try and lock in that key talent. If they fail at that, paying a 30% premium is just, well, instant value destruction for shareholders.
Okay, let's zoom out to the market view. With all of this M&A activity, you'd think healthcare stocks would be flying high. Is that what's happening?
And that's what's so fascinating. No, there's a major disconnect. Despite all the spending, healthcare equities have actually underperformed the broader market. The entire sector is trading at valuations near a 35-year low relative to the S&P 500.
A 35-year low. That's incredible.
Yeah.
It sounds like the market is pricing in a ton of pessimism.
A tremendous amount. It's mostly driven by uncertainty around drug pricing policy and real worry about whether these acquisitions can fill the revenue gap from the patent cliff fast enough. We do see a bit of a split, though. Medtech stocks have done better than pharma.
Why is that?
They're just less exposed to those drug pricing debates. And the revenue is driven by procedures, which is a more stable, recurring model, especially with an aging population. But, if you look at the big picture, the fundamentals for healthcare are still incredibly strong. Aging demographics, chronic disease. History suggests this kind of consolidation does lead to strong long-term returns, but, and this is the big, but only if management pulls off the integration.
So to wrap it all up for you listening,
Yep.
This is a huge structural reshuffling. It's being driven by two things: necessity, which is the patent cliff, and massive opportunity in things like GLP-1s and precision oncology.
Yeah.
The big players have decided that buying is the best way to grow.
And that really raises the key question for you to track going forward. The market has clearly priced in a lot of bad news. That 35-year low tells you everything. So the question isn't if more deals will happen, they will. The question is whether these giants, the J&Js, the Mercks, can actually translate all this spending into real shareholder value. It's all about execution now, not just deploying capital.
See you all in the next Pro Ticker Deep Dive.